Budgeting. So, when we're talking about stuff, like so far, I've always just given you the rate. You haven't had to come up with it on your own. But do you think that's the way it works in the real world, that the gods of finance just hand down a rate to you? No. Do you think the gods of finance exist? No. Okay, so we have to figure out how to do that for ourselves. And so what we're going to do in this lecture is to figure out how we can determine a rate that is appropriate to the risk of the cash flows of these projects that we'll be looking at. And so what we're going to do is look at the riskiness of these cash flows from the projects and compare them to the riskiness of cash flows from financial instruments, because we have these great markets for pricing risk. They're called the markets. They're called the bond market and the stock market, right? And so you can actually go out there and figure out what level of return is required for a certain level of risk in those cash flows. And then we can find a similar riskiness of our cash flows in the project, and then we know how to price that. Okay, now, something to know about firms. They're financed with a mix of debt and equity. Typically, for sure you can see a firm that is 100% equity, but can you ever see a firm that is 100% debt? No. You always have to have somebody that owns the darn thing, right? In fact, the highest levels of debt that we tend to see for healthy firms are around 90% debt to assets, and that would be with banks. But you'll never see a totally equity or totally debt financed company. But what we're going to do is we're going to figure out what is the cost of a company's debt, what is, meaning the rate, and we're going to figure out the required rate for their equity, and then we're going to use that information along with the proportions of these things in the capital structure to figure out what is the required return for the company. And it turns out, if the project that we're doing is just as risky as any other project at the company, or as the average project at the company, then we can just use that rate as our discount rate for the project. Okay, so that means we've got to figure out the cost of equity capital. And we've already discussed that we've always got equity. And you may think, well, wait a minute, equity's free, because after all, as we discussed a time or two ago, our firms are required to pay dividends. Are firms required to pay dividends? They're absolutely not required to pay dividends. You say, well, wait a minute, the cost of that equity is then zero. Is that true? No. Remember that total return is a combination of the capital gains yield and the dividend yield. Even if the dividend yield is zero, people's required capital gains yield could be higher, meaning that they're only willing to purchase your stock at a discount. And so the higher that capital gains yield is, probably the lower the stock price will be that they would be willing to pay. And that's a cost. That discount is a cost to the firm. It's a cost of financing. And so we need to figure out some way, or more than one ways, to calculate our required cost of equity. And the first you already know about. Actually, you already know about two of these. So remember from our talk about portfolios that we talked about the security market line. We talked about the security market line. That's the one where we use beta and the expected return on the market and the risk-free rate in order to come up with the expected return on the stock. And the second one is the dividend discount model, which is where we use the information about the stock price and the expected growth rate and things like that to come up with the required return on the company. Now the question is this. We know these things because we've talked about them recently. We know these things have different ingredients. And so as you are looking at a problem, how do you know which of these to use? Well, it's actually quite simple. What I do is I look at the ingredients that I'm given, and then that tells me which one I should use. It's kind of like tonight. I'm going to go home. By the way, I do all the cooking at my house. I'm going to go home and I'm going to look in the cupboard and I'm going to see that I've got pasta, I've got marinara sauce, I've got some cheese, and I am going to know what I'm going to cook for the evening. What am I going to cook? Some sort of pasta with tomato sauce and cheese on top. By the way, my wife's very easy to please with cooking. That's why I'm allowed to do the cooking at my house. Now, back to this story. It's the same way with this. We look at the ingredients and we can figure out which dish we're going to cook. If I give you the expected return on the market, the risk-free rate, and the beta of the stock, which one of these should you be using? Oh, swing and a miss. If I give you beta, beta shows up in the security market line. Now, I'm going to give her a chance to redeem herself here. What if I give you the dividend at time one, the current stock price, and the growth rate of the dividends? Which one of these should we use? Yeah, the dividend discount model or the dividend growth model. It goes by many names. And so that's the other way that we're going to do this. And we're going to know which one we're going to use based on what information we're given. Now, what if we're given enough to do both? What do you think we should do? Do both, and then what?
Check your answer.
Ooh, okay. Well, we're in the real world. Can you check your answer?
Oh, I thought we would get the same answer and compare and make sure.
Ah, okay. So, in theory, they should give you exactly the same answer. Do you think that works out always in the...
Probably not.
Probably not. Now, what I'm going to tell you is you'll probably get two slightly different things. Which one of them's right? We don't know, right? So we've got two guesses here. What should I do with them?
Average them.
Average them. Isn't that brilliant? You get to... By the way, these are both estimates or swags. What does swag stand for?
Scientific wild ass guess.
Very good. Scientific wild ass guess. And so we can't say for sure that one of them's more accurate than the other. So what do? We just add them together and divide by 2. Isn't that simple? Pretty simple way to look at it. So here's the security market line. Hopefully you're still familiar with that. By the way, do you think it should be on your note sheet for the next exam? Absolutely. Oh, absolutely. Okay. Now, what kind of ingredients do we need to do? By the way, expected return on stock I, that is the cost of equity using the security market line. And then we've got R sub F. What's R sub F? The risk-free rate. And then we've got beta sub I. That's the beta of stock I that we're trying to find the return on. And then that thing in the square brackets, we actually have a name for that thing. What is it?
MRP.
Say again?
MRP.
Yeah, MRP. What does MRP stand for?
Market risk premium.
Very good. It's the market risk premium. It's actually on the screen. What was that?
I said it took me a minute.
Oh, okay. So I came out of manufacturing, and back then MRP was manufacturing resources planning. And so I get confused when we say MRP because it could be more than one thing. Okay. And then we can actually find the risk premium of that stock just by looking at beta times that market risk premium. But there's one more thing in here, and that is the expected return on the market is the E parentheses R sub M. Now, does anyone remember why we have to put the E in front of the expected return on the stock and in front of the expected return on the market, but we don't have to do that with the risk-free rate?
Because the risk-free rate isn't predicted. It's not expected.
Yeah, so I think what you're trying to say is the risk-free rate is known with certainty.
Yeah.
Yeah, so it's not a scientific wild-ass guess, right? It's something that we know with certainty. And by the way, how can you know it with certainty? Because it's risk-free, right? Does that make sense? Okay, any questions? So what do we need to make this thing work? Well, we need an estimate of that risk-free rate. We need an estimate of the market risk premium. And we need an estimate of the equity securities beta. So where are we going to get that risk-free rate? We've talked about this before, but it's worth hitting on again because some of you have forgotten. And that is that our stand-in for the risk-free asset is the 3-month U.S. Treasury bill. And why do we use the 3-month Treasury bill? Number one, in theory, it's default risk-free, right? In theory. So the other kind of risk when you loan money to someone is the interest rate risk or price risk. And we know that that's worse with longer time to maturity. Well, 3 month is very short, and so we use that. Now, some would say, wait a minute, 1 month is even shorter, therefore it has even less interest rate risk. But the reason that we don't use the 1 month is because it's really not all that popular. It doesn't trade all that frequently, and as a result, we might not have a good, solid price on those Treasury bills, and so we stick with the 3 month. So, for purposes of solving problems, when you guys are working through homework or an exam, and you're like, wow, where is the risk-free rate? It's whatever Treasury bill I've given you. It's whatever Treasury bill I've given you. That's always your risk-free rate, unless I just spell out the risk-free rate is. Questions? Okay, now we're going to talk about estimating the market risk premium. Remember, the market portfolio is every asset known to man, every risky asset known to man, held in proportion to its importance in the overall world economy. But we said there's a problem with that. Can we actually recreate that portfolio? No. In fact, not every risky asset is frequently traded, therefore we don't have good prices and returns on that. And so we have to figure out, just like we did with the risk-free asset, we need to figure out some sort of stand-in for that market portfolio. In the United States, we use the S&P 500. Why the S&P 500? Well, first of all, it's got 500 stocks in it instead of the Dow, which has 30, right? And the second thing is that the S&P 500 is market value weighted as opposed to the Dow, which is price weighted, which is an extraordinarily crazy way to come up with an index. By the way, Dow Jones Industrial Average is the oldest index that I know of. And what they did is they started out by picking like the top 30 companies in the United States and just adding all their prices together. Not very scientific. Why isn't it scientific? It wasn't created by a finance person. It was created by a newspaper dude, right? That's why it's not very scientific. Okay. Now, how many years do I go back to figure out what is the expected return on the S&P 500? We have data going all the way back to 1926. Statisticians would tell us we should go all the way back because of the huge sample size, right? The statisticians always think that the bigger the sample, the better. Are they right? If the data is all equally fresh, they're absolutely right. The problem here is that data changes. The economy has changed over time. Let's roll back to 1926. My grandfather was a boy, and he was a farmer. And most people were farmers. The United States economy was overwhelmingly agricultural. Move on to World War II. What happens to our economy during World War II? Do you think we farmed our way out of that mess? No, what did we start building? Factories, right? And so then we had an industrial economy. And then you move around to the 1980s and we start talking about a service economy. And now what are they calling it today? The information economy. Do you think that all of those different economies would have similar expected return on the market portfolio? No. And so you can't go back all the way to 1926. In fact, I wouldn't even go back. I would probably say 5 years is about where I would put it. And then you got to start asking yourself, well, has anything really funky happened in the last 5 years? Well, it's kind of really hard to find a time in history when you don't have a 5-year period without funkiness, right? So what's been our most recent funky thing? COVID? Actually, there's something more recent than that.
Oh, Ukraine war.
Yeah, so we got Russians in Ukraine, we've got COVID, we've got whatever the hell, we got inflation, we got all sorts of crazy stuff going on. And my point to you is this: are you ever going to be able to find a totally clean period of time. No. And by the way, are the next 5 years going to be totally clean? I guarantee you something stupid will happen, right? And it could be something stupid fun, right? And things will go, yay, we have a really good time. You know, like the dot-com boom. But what was the dot-com boom followed by? You guys don't know this? Yeah, dot-com bust, right? Booms are almost always followed by busts, right? Okay, so just because a data point is funky, should you throw it out? No, life is funky. Questions? Okay, so if you recall back how we did beta estimation with linear regression, we used Excel and we used data on GE prices, and we used the 3-month treasury bill, and we calculated beta for the firm. But remember, betas tend to vary over time. I showed you how Microsoft has changed over the last 20 or so years. And so what you need to do is find a beta of the firm that most represents its current format. So for example, with a utility firm, it's pretty easy because they've continuously just been making and selling electricity. But what about, let's talk about Netflix. In the beginning, what was Netflix's business model? Mailing out DVDs. And it was always such a thrill to open the mailbox and see that red sleeve. And sometimes they would mess with you by mailing out a red postcard that same size, and we'd pull up to the mailbox and my wife would open it and she'd be all thrilled, and then we'd realize it's just a damn postcard, right? Okay, so that would be one business model, and that would have one beta. And then they moved on to, what's the next thing? Streaming. Now, the question is this: whose stuff were they streaming? Was it stuff that they made or stuff that was made by other people? Yeah, stuff that was made by other people. And so this is a different phase of their business, a different beta. Now, let's move on from there. What's Netflix really all about now? Yeah, original programming. And some of it's okay. Some of it really stinks. In fact, I recently canceled my subscription to Netflix because they just stopped making fun stuff like Tiger King. And anyway, so yeah, it's a guilty pleasure. Okay, so back to the story. Do you think their beta's different now that they're making their own stuff than it was when they were shilling other people's stuff? Yeah, of course it is. And so you need to do, if you were looking at Netflix, is go back as far as this current business model has persisted and use that beta. Okay. I think that's all I want to say there. Oh, actually, here's Microsoft. So it changes over time. And we're up here looking at 1993 to 1997. The beta is 1.28. Is Microsoft riskier or safer than the overall economy? Yeah, it's riskier. By the way, 1993, that's my next to last year of college, undergrad. Windows just came out. Actually it was Windows 3.1 was the first one that I saw. That was 1993. Did Microsoft have a solid hold on the entire market at that time? Most of you probably don't know because you weren't alive. But Microsoft did not. There were other operating systems, and there was MS-DOS. And since I was already trained on using DOS, I wasn't really high on this whole Windows thing. So Microsoft's a little risky there. And then as we move into the dot-com boom era, which is or dot-com boom and bust, 98 to 2002, you can see that Microsoft has an even steeper beta of 1.75, indicating that it's even riskier. Now, here's what was going on at that point. At that point, you could take any company and put .com on the end of it, and it would instantly trade for more in the market, even if the company didn't own a single computer. I'm not kidding. Someone did a paper on that, and they showed that people that just slapped .com at the end of their name, that the stock price immediately went up. Now, during this time, Microsoft, of course, has the smell of technology about it, and people are assuming that people who are building these websites are probably using Windows-powered machines, right? And so you see Microsoft get swept up in this whole .com boom and bust, and that's why their beta was higher during that point. Now moving forward, 2003, 2007, almost everybody is using Microsoft Windows, and almost everybody is using Microsoft Office. Microsoft is starting to look like a whole lot like a utility. Does that make sense? And therefore, it's not any riskier than the overall market for all the time period that we're seeing here. Now, there are 2 points I want you to get out of this slide. Number one is a company's beta does change over time. And number two is, let's take a look at these black dots. Those black dots are combinations of return on Microsoft versus return on the S&P. And that's what we're trying to draw a line through to get the slope of that line, which is our beta. Now, do any of you, have any of you ever shot a shotgun? Okay, when you shoot a shotgun, does it make one neat hole? No, unless you're using like one of those slugs. It leaves a pattern, right? What I want you to do is take a look at these patterns and tell me if you've seen similar things on targets when you were shooting a shotgun. This looks like birdshot to me, maybe a 7 or 7.5. Well, anyway, so it's small shot. It comes out and it makes a random pattern. Would it make any sense for us to look at the shotgun blast, and let's assume I shot a graph like this. Would it make any sense to look at that and say, well, wait a minute, I can make a line out of that. I can figure out the slope for that. No! Now, some of these are better than others. Look at 98 to 2002. I can somewhat, kind of, sort of see a line. What about 2003 to 2007? That's almost pure shotgun, right? So, here's what I want you to get out of that little discussion. That these things, these calculations of beta are all swags. They're all scientific wild-ass guesses. And a lot of times students will say, well, wait a minute, I know the beta is 3.12, so therefore, and what I wanted to tell them is we don't truly know. What we have is our best guess, right? That's all these things are. They're our best guess. And we're eventually going to use the beta to figure out the expected return on the stock. We're going to use that to figure out the expected return on capital at the company, and we're going to use that on a project that's equally as risky as any other project at the company, and you're going to come up with an NPV of 32 cents. Now, technically, any positive NPV project should be accepted or rejected. Accepted! But you need to recognize that everything we threw into that blender, a lot of it is scientific wild-ass guess, right? And so should you really accept a project with only 32 cents positive NPV? In reality, no way, right? Because there's all this guesswork that's been thrown into the blender. Does that make sense? Okay. Now, your book says, wait a minute, we don't have to go back in time to figure out to get a bigger sample for beta. All we have to do is find other companies doing exactly the same thing, and then all we have to do is find just like 1 year's data for that, and if we can find 5 companies, that's like finding 5 years for one company. The sample size is that much bigger. And that sounds like a reasonable argument. And if you could find 5 companies doing the identical same thing, that's a very good argument. But the problem is finding those 5 companies. And so the example is the software industry. Apparently we're a software company. We're wanting to know what kind of beta we should be looking at. And so the book says, well, wait a minute. Let's just throw up all these software betas, and then we'll just average them. And bada bing, bada boom, we're good to go. Theoretically, they're right. However, there's a problem. Let's take a look at these and figure out what the problem is. Number 1, Microsoft at the top of the list. Beta 1.17 at the time this was snapshotted. Is Microsoft a software company? Mr. Zach is undecided. Yeah, so do they make software?
Yeah.
Yes. Is that all they make?
No.
No! What else does Microsoft make that many of you probably have at your place?
Gaming systems.
Gaming systems. So what's it called? The Xbox 360, the Xbox One, the Xbox -2, whatever it is today. They keep renaming it. And it's not like Xbox 1, 2, 3, 4, 360. What happened to up to 359? Okay, so is that software or is that hardware?
Hardware.
That's hardware. And then you'll see the Microsoft Surface, software or hardware? The Surface? The Surface is hardware, right? If you can tap on it and it makes a sound, it's hardware, right? And so, therefore, we know Microsoft is not a pure play software company. Okay, so we're gonna scratch them off the list and we're gonna move on. Apple. No, why? They make hardware, and how can I tell? Oh, it's right there. How can I tell? I usually pull it out and tap it, right? I pull it out and tap it, and it makes a noise. You know it's hardware. In fact, I would say Apple is more hardware than software. And then we have automatic data processing, or ADP. How many of you get a paycheck or stub that says ADP on it? You guys ever get one of those? You don't know? You have no idea. As long as it cashes, you don't care, right? Yeah, I'm kind of with you on that.
Transparent kind of on that check.
Oh, well, it's on the stub itself, it'll actually have it printed.
Okay, I think, yeah.
Yeah. So let me tell you what ADP does. ADP has created a web portal. So far, it sounds like software, right? And this web portal allows people to go in and type in the number of hours that people work, and their salary information, their insurance information, their information about union dues, and all that. And then ADP figures out how much these people should be getting in. So there's the big number on the check, and then there's a little number. ADP is all about the little number, right? So they figure out what all this stuff should be, and then they basically create the payroll. Now, at that point, if they just emailed that information back to the company and the company paid, then we might still consider them a software company. But that's not what they do. What they do is they actually have access to these, oh bless you, these small and medium employers. They have access to their bank accounts. And so they actually pay from your account, pay your employees. Of course, they send you information on how much they're paying, and you got to make sure that you've got enough money in the account to cover it, but that's how that works. I remember that the last company that I worked for, strangely, we got paid every week, which is weird. And every Friday afternoon, the FedEx person would come, and they would have the box with the checks in it. And we would all, we're up against the windows, waiting for the FedEx person to come. Now, I'm going to give you a little piece of business advice here, just off to the side regarding paychecks. The time will come when you are a manager or a supervisor and the checks come to be handed out. Do you hand them out yourself, or do you let your administrative assistant do it? The administrative assistant is what you would all assume, and that's what I assume too. So the first time the paychecks come, and they come in, and my right-hand man, Carl, says, do you want me to hand them out? I said, yeah, go ahead and hand them out. And the other three supervisors standing in the office all gasped. Okay, so after Carl left, I'm like, whoa, what's up? They said, no, you always hand the checks out. And here's why. Because these people need to know that you are the source of every good thing in their life, and they better fear you because you could also, take that away. They said it's a psychological thing. Do you think I ever let Carl hand the checks out again? No. Absolutely not. Hey, Roy, thanks for your hard work. Right? Okay. There we go. Okay, so that's ADP. Is ADP a software company?
Not necessarily.
Not necessarily. They're more like a business services company. So scratch them off the list. Oracle. What do we know about Oracle? What is their big product?
I do a lot of invoicing to there, or a lot of accounts receivable, or,
Yeah, so you're seeing a little piece of Oracle there. I'm seeing, by the way, I think Banner is actually a product of, if you trace it back, it's Oracle too, right? Banner, the student system that we use here. They're databases. Yeah, so now you know you don't like Oracle, right? Okay, so they're databases, and so that was Oracle's big claim to fame. And if that was all that Oracle did, we'd be perfectly fine saying that Oracle's a software company. But Oracle also bought Sun Microsystems, and anytime I say Sun Microsystems, students always say, "Oh, Java," right? But Sun Microsystems also, at least at one point, made hardware. When I was an engineer and I was using my CAD scope was made by Sun Microsystems. So is Oracle a pure software company? No, scratch it off the list. Computer sciences, I'm not sure what they do. We can leave them on the list if you like. Computer Associates, this is the next one. And they're really kind of fun. What they would do, by the way, when you get to your first major employer, you're going to notice something weird. There's going to be a lot of stuff that's going to be done on regular Microsoft stuff. But when you want to interact with the company system, you are going to use something called the 3270 emulator. And you're going to pull it up, and suddenly, whoop, there is a green and blue screen, and you are transported back to the 1980s. And you're like, what the hell is this? They're going to say, well, that's how you interface with the mainframe. The mainframe is totally obsolete. The problem is nobody wants to move away from the mainframe because it's a huge problem to do so, right? You have to recreate all this stuff somewhere else before you can put a bullet in the mainframe. And so what do people do? They Band-Aid and baling wire keep these mainframes together. And in fact, if you go into, anybody here work at Bass Pro? Anybody here shop at Bass Pro? Yeah, I know you do. You've got the freaking hat on, right? Okay, so if you go in there and they ask, are you a member of our loyalty program or whatever they call it? And you say, yeah. And they say, you got your card? And you say, no. And then they say, well, wait a minute, what's your phone number? And you give them your phone number. They pull up this screen and they start typing it in. Take a look at that screen. That's a 3270 emulator. Somewhere in the back office is a huge mainframe computer grinding away, eating up parts that are left over from the 1980s. So that's how that works. Now, what does that have to do with Computer Associates? Well, it turns out that the people who program that stuff are long dead. And the companies that came up with those programs are probably bankrupt. So what does Computer Associates do? They come in and they kind of help you patch and stick together with glue and whatnot your mainframe software to kind of keep that old pig running until you can figure out something better to do. Is that truly a software company? That's more like a business services company. So we're going to scratch them off the list. Then there's Fiserv. How many of you know about Jack Henry? Oh my goodness. Did you know that one of the in fact, probably the preeminent provider of software for banks is located right here in Southwest Missouri? Jack Henry. I'm not kidding. And not in Springfield. They have an office here. They're located in Monette. How many people live in Monette? Something like 10,000? Yeah, it's not that big. Okay, what's my point to you? So Jack Henry does this banking software. Fiserv does something very similar. And so you might be tempted to think, well, they are a subtype of software, but they're still software. Except for one thing. Fiserv also processes credit card transactions. Is that software? No, that's more like a business service, so we got to scratch them off the list. Then there's Accenture. So my cousin used to work for Accenture, and what he did, he would go into companies that wanted to get away from their mainframe. He would help them choose a software package, and help them install it on their machines and get that thing up to running so that they could turn the mainframe off and then shoot the mainframe. You know, like an old horse in a Western movie when the horse breaks its leg. Isn't that cool? Okay, so back to the story. Are they truly doing software work? No, they're not writing that software. In fact, they're software agnostic. In the end, if you wanted to install software written by a bunch of monkeys, they would do that for you for the correct price, right? Okay, probably not monkeys. Maybe, well, I don't want to go into that. So the point is this. They're a business services company. They're a consultant. They are not a software company, so we've got to scratch them off. And then we've got Symantec. What do we know about Symantec? Nobody knows? Oh my goodness. Symantec makes Norton antivirus. Yeah. Now, I know that we nowadays probably, most of us are using like Microsoft Windows Defender or whatever, so we're not actually having this software anymore. But Symantec's still around. And the question is this, are they a software company? Of course they are. But are they truly representative of a regular software company? I would argue they're not. And here's why. What is the last piece of software, what is the first piece of software that you would want to keep updated on your computers? Would it be Microsoft Office? I'm using Microsoft Office 2016. That pig's running just fine, right? But what about 5-year-old antivirus? You're good with that, Mr. Zach? You're not, okay. 5-year-old, so this is really the first thing that people are going to spend money on if they have money to spend on software. And so that's why we see that their beta is so low. Does that make sense? Then we have Paychex Inc., and they do almost exactly the same thing as ADP. And by the way, check out their betas. Do you see that they're very similar? If I were wanting to start a company doing that business, I would know what to use as the beta, right? So, my point to you is this. We went through there and basically were able to eliminate almost all of these. It's very, very, very hard to find someone doing exactly what you're going to try to do. So this argument of finding the average of all these is probably a pretty bad one. Now let's talk about business cyclicality and beta. So the business cycle, we know that we go through rounds of expansion and contraction in the economy. Right now our economy is growing. People are starting to say maybe the economy is going to contract. If your business is cyclical, it means your sales go up during good times and go down during bad times. Let me say that one more time. If your business is cyclical, and another name would be pro-cyclical, cyclical or pro-cyclical, then we are saying that when the economy is growing, your sales are up. When the economy is shrinking, your sales are down. And most businesses, to some extent or another, are cyclical or pro-cyclical. But there are some that are counter-cyclical. For instance, let's talk about cheap liquor. Cheap liquor. When times are good, do you guys say, hey, I just got a promotion at my job. I'm gonna go, what's a really cheap liquor?
Keystone.
Oh, what's that?
Congress.
I've never even heard that.
It's vodka. It's not very good.
It's not very good. Let's go back to our Keystone example. We'll use cheap beer instead of cheap liquor. Keystone. By the way, I have some old neighbors, and they're always inviting other neighbors to drop by for a beer. And once the word got out that it was Keystone, nobody goes to their house. Isn't that sad? Recently, they've upgraded to Stella, and they have a lot more friends. Okay, back to the story. Keystone. You say, hey, come on over, guys. I just got a $10,000 a year raise. Keystone's on me. No. You're going to bring out the good stuff, at least Stella, right? Maybe something even fancier. Who knows? By the way, those 11 point whatever ounce bottles they sell Stella in, that's 330 milliliters, which is a standard size beer for Europe. So trying to make you think that that crap is actually imported from Belgium. Do you know where it's actually made? St. Louis. Yeah. Okay. Back to the story.
You said, like cheap liquor would be counter-cyclical?
Yeah, because sales go up during bad times and down during good times. Thank you for getting me back on point. Okay, so counter-cyclical, things would be good during bad times and bad during good times. So it moves the opposite direction. And typically we would think that those things have low or negative beta. So like gold mining stocks would be a counter-cyclical business. And then there are some businesses that aren't that cyclical at all. For instance, electrical power. Used to be we were an industrialized nation and a lot of the electricity went to creating stuff. Today, most of the electricity goes for lighting and air conditioning. When times are bad, are you guys going to go home and turn off your lights and air conditioners, sit in the dark and sweat? Probably not, right? And so they're not as cyclical as they used to be. What about Band-Aids? Do you think people are like, I cut myself, it's bleeding pretty bad, but you know I don't know if I'm going to have a job next Thursday, so I think I'll just let it drip. No, that doesn't really happen, right? And so you see a lot of like medical type stuff is not necessarily all that cyclical, except for, say, plastic surgery. Do you think plastic surgery would be pro-cyclical? Absolutely, because it's elective or discretionary. Okay. So, remember, beta represents sensitivity to systematic or market risks. So, if a stock is cyclical, it's sensitive to the underlying economy. That's going to have a higher beta than a non-cyclical stock will have a higher beta than a counter-cyclical stock. So, I'm going to start trying to draw a picture up here. So if the economy is up, then sales are up, and we're going to use a pro-cyclical here, and that's due to business cyclicality. Okay. Now, remember the cyclicality is not simply volatility. Just because some things, sales go up and down does not mean that it's cyclical. Example, movie studios. Movie studios, why do you think their revenues are up and down? What causes their revenues to go up and down? Is it because the economy's up and down?
Depending on the success of the movie.
Yeah, depending on the success of the movie. And so if you put out a movie like Frozen, not that I've ever seen it, but you put out a movie like Frozen, what happens to your sales?
This guy.
Right? And then you put out a stinker like Paul Blart Mall Cop 7. What's that?
I was going to say the first one.
Oh, you like Paul Blart?
I love Paul Blart.
Oh my goodness, we got so much work to do, Miss Hep. Oh, anything with a segue in it. Yeah. So back to the story. The point is that those cash flows are volatile, but they are not cyclical. And so we're not going to see those things impacting beta like if they were going with the economy. And here's why. How could I get myself away from that cash flow volatility of owning one movie studio? I could buy shares in all of the movie studios. Because undoubtedly when Paramount has a great movie, Sony's going to have a stinker. When Columbia, does Columbia even around anymore? I don't even keep up with this stuff anymore. But when Disney comes out with something really bad, maybe another studio comes out with something really great. And so I can diversify away that risk. Therefore, we know it is not systematic market kind of risk. Does that make sense? So it doesn't have anything to do with business cyclicality. Questions? Now, I had a student one time ask me, should an owner care about volatility that's not cyclical? And the answer is, if you are the sole owner of this company and your wealth is all tied up in that company, should you care about cyclicality? Absolutely, because you're not diversified away from it. I'll give you an example. I think I've told you before, my sister is an owner of 25% an owner of a company, right? Should she be concerned about that? Yeah, her overwhelming wealth portfolio is invested in that company. And so it makes sense for her to be concerned about it. Should I be concerned if I were, say, if I could buy stock in a similar company? Should I be concerned? Absolutely not, because I can diversify that away. Does that make sense? So we're concerned about business cyclicality. We're not concerned about volatility as investors, and therefore it doesn't impact beta or the required return. So we've already discussed how the economy impacts sales. And the next thing we're going to look at is how do sales impact profits? And the relationship between the change in sales and the change in profits is called operating leverage. Now, our book defines it as the percent change in EBIT. What's EBIT stand for? Earnings before interest and taxes. What's the other way you may hear people pronounce this? EBIT. And how do you know that you're wrong? Whichever one you say, people will always say the other. Okay. And divided by the change in the sale. So by the way, percent change in sales. The delta means change, right? And so we're looking at how the change in sales, that's the bottom part, impacts our change in profit. You may see other measures of this. You may see people using net income. You may see people using operating cash flows, but the idea is exactly the same, and that is, how does this change in sales impact whatever our measure of profitability is? So a higher operating leverage means that a small change in sales leads to a large change in profit. By the way, the lowest operating leverage you will ever see is 1. The lowest operating leverage you will ever see is 1. And let me explain what determines operating leverage. There are two kinds of costs at firms. There are fixed costs and there are variable costs. Variable costs vary directly with whatever good or service we are providing. So it's your raw materials, your labor, electricity that's used for production, that sort of stuff. If you have no fixed costs whatsoever, then when your sales double, so do your costs. But then your profits also double. Does that make sense? Because there is no fixed cost to cover. But what if we have fixed costs? Then suddenly that operating leverage can grow. Let me give you some examples a couple of examples here. Number one, let's talk about a Swiss watch company that they make luxury leather watch bands. By the way, have you ever watched the show How It's Made? I love How It's Made. I was watching this one and they're like, see how luxury Swiss leather, and I'm expecting some sort of high-tech facility with people in lab coats, and no, it was a dude sitting at his table at his home with a big block of wood, a pot of glue, some thread, some bits of leather, and some buckles. That guy's costs are almost entirely variable. Why? He probably already had the table. That block may have belonged to his grandfather for all we know. In other words, he doesn't have monthly rent that he's paying. There's nothing about his operation has fixed costs. And so if let's say his wife says, you need to make 25% more money. What does it mean? It means he has to make 25% more watch bands. Sales are going to go up by 25%. And because his operating leverage is 1, because he has no fixed costs whatsoever, then his profits go up by 25%. Operating leverage is 1. But now let's go across the continent, and now we're in China. And we're at a watch band factory in China. And do you imagine it works quite differently? Oh yeah. And so, in fact, when I pointed at this earlier, I shouldn't have said luxury Swiss watch band. I should have said cheap watch band made in China, right? So why is it so much cheaper? Well, they've taken out a lot of that variable cost, the labor portion, by investing in this amazing machine. And so you got two guys on this end putting cowhides into the machine, and then the machine goes and spits out watch bands on the other end. And you've got a guy down here catching the watch bands in a big box and swapping out the box. We're making thousands of watch bands per hour, and we got 3 people working there. We've got huge volumes, so our materials costs, we're getting quantity discounts on that. In other words, the variable cost is a very low part of this operation. The fixed cost is a very high part of the operation. Now, here's the way to think about fixed costs. Your sales, when you start to sell stuff, you're looking at the sales price minus the variable cost, and that gives you the contribution margin. In the beginning, that contribution margin goes to covering that fixed cost. But everything after that, in a world without taxes, goes straight to profit, right? And so this company, as they climb away from that, their profits are going to grow much faster as that rate of sales increases. And so let's say their operating leverage is 3. If their sales go up 25%, then their profits are up 75%. Doesn't that sound cool? What's the problem though? What happens if sales go down 25%? The guy that's sitting at his kitchen table, what happens to his profit? It goes down 25%, right? Because it goes down the same level as the sales. What happens to profits at the Chinese watch factory? It's down 75%. And so operating leverage is great as long as you're growing sales. It stinks when you start to lose sales. Let me give you an example here from the automotive industry. If I tell you to picture in your head a Japanese car factory, do you see in your head people or robots?
Robots.
You see robots, and that's what I was expecting when I visited the Honda plant in Liberty, Ohio. That's exactly what I was expecting. And I walk in there, and instead what I see is a row of Honda Civics, and there are these people swarming around them like bees. People everywhere. I had trouble finding robots. Now, let's compare that to a General Motors plant. If you go to a General Motors plant, you're going to see a lot of robots and fewer people. Now, you might ask yourself, why would they choose to set up their business in that way? Any ideas? Okay. You're warm. Yeah, it's the labor cost. By the way, the people working at the General Motors plant belong to the United Automotive Workers. The people at Honda are not unionized. What do you think that means for labor rates at Honda versus GM? Yeah, it's lower. And so it makes a lot more sense for Honda to throw people at a problem than machines. It makes a lot more sense for GM to throw machines at a problem than people. And this trade-off, you can actually see it for yourself. 10 years ago, when you walked into a McDonald's to place your order, you had precisely one choice of how to do it. What was it?
Talk to a person.
Talk to a person, right? Now you walk into a McDonald's, and what can you do? Order on the machine, yeah, or you could use the app. Now, why would they put those kiosks in? When did those kiosks start showing up? When people started demanding a $15 an hour minimum wage for people working at McDonald's. McDonald's is like, hey, no problem. You just made it cheaper for us, or you made it more reasonable for us to install all this automation. By the way, there is a burger flipping robot named Flippy. Did you guys know that? Yeah. And you think Flippy is coming for the jobs in the back of the house at McDonald's? Absolutely. Do you think Flippy gets high on his break?
Yes.
No. No. You're going to need to explain to me later how robots get high. I'm sure my Roomba would appreciate knowing. Okay. Now, where were we at? Oh, so my point to you is this. At GM, the variable costs are lower, but the fixed costs are, oh, come on, robots. Robots are a fixed cost. Can you go up to the robot and say, I'm sorry, robot XR41J, we don't have as much work as we used to. You need to take your oil can and go home. What does the robot say? Beep. First of all, it doesn't speak English, right? So my point to you is this. Robots are a fixed cost, but they lower variable costs. So anyone that has those, has automation like that, that's employing machines instead of people, is going to have a higher operating leverage. So let's look at Honda versus GM, good times versus bad times. So let's say that automotive sales are up, and forget the supply chain shortage. Just automotive sales are up. They can make every car that is desired by customers. Customers are desiring 50% more cars. By the way, if you've never worked in manufacturing, most manufacturing operations are 2 shifts of 8 hours each. And then if things get to be really hopping, we add a 3rd shift. At Honda, there are 5,000 people per shift. And so for a Honda to put on a 3rd shift, they have to go out and hire and train 5,000 new people. Those people represent a variable cost. And as a result, the overall costs at Honda are going to go up considerably when they have to boost production by 50%. Now let's look at General Motors. And of course, I'm exaggerating the numbers here. But let's say at General Motors, you need 6 people per shift to watch the robots. How many people do I have to add at General Motors to increase production by 50%? 6 people, right? That's it. And so when times, so by the way, GM's costs have only gone up a little bit. Their sales have gone up by 50%. What's happened to their profits? To the moon, baby, right? They are way out there. But what about Honda? Same percentage of sales increase. Do their profits go up as much? No, because their costs have gone up a lot more than GM's because they're using labor, which is a variable cost, instead of robots, which is a fixed cost. And so what happens is this operating leverage at the firm basically magnifies this business cyclicality. And so the greater the operating leverage is, the greater the ratio of this change in profits to the change in sales. Okay, together, this is the risk of the assets. And in fact, in finance, we like to say the risk of the underlying assets. Underlying assets. The risk of the underlying assets. Now, you might think that's the end of the story. And we're going to see that that is a form of beta. It's the beta of the assets is all determined by these 2 things. But now we're going to look at one more thing, and it's called financial leverage. Financial leverage. Let's see, how do I want to say this? Okay, now it's kind of like operating leverage in that if the firm has no debt, it has no fixed cost financing, and therefore the leverage is 1. And so as profits go up, you'll see the stock price go up, but not hugely. But what about if we have a firm that is half debt? Well, now we are paying interest on that debt, but the remainder of the money flows to the stockholders. Well, if the stockholders only have 50% as much money in the company, basically they've almost doubled their return. In fact, let's take a look at, so you can think about this stuff being related to ROA. And you can think of this stuff being related to ROE. And what's the relationship between ROA and ROE? It's the equity multiplier. And what's the equity multiplier? That's total assets, by the way. And so as debt goes up, this equity multiplier goes up, and the return on equity increases more given the same ROA. So that's what's going on here. And so we can see what goes into the shareholders' pockets is greater if we're using financial leverage. Now, when I finally throw financial leverage into the picture, now I'm talking about the beta of the equity, which is the beta of the stock. Example that we came up with for General Electric, remember that? That General Electric beta had to do with the fact of their business cyclicality. It had to do with the way their business is organized, operating leverage, and it had to do with the way their business is financed, and that has to do with their capital structure. And so basically all three of those ingredients go in to finding the beta of the equity. Questions? So let's talk about a firm that's got really high beta of equity. First of all, it would be very cyclical. It would go up, sales would go up a lot during good times and go down a lot during bad times. That's the first thing. Second thing, they would have a lot of fixed costs and very little variable costs. So they would have high operating leverage. And the third thing is they would be financed primarily with debt, as little equity as they could get by with. And when you put all three of those things together, you would come up with an extraordinarily high beta of the equity. Now, what do we know about firms with extraordinarily high betas of the equity? Let's say it's 7. Let's say it's 7. When the market is up 1%, how much is that firm going to be up? Yeah, 7%, right? That's what beta is. And you're like, damn, I've got to get me some of that. But here's the problem. What happens when the market's down 1%? This firm is now down. Yeah, the stock is down 7%. So the higher that beta is, the riskier it is. The higher the business cyclicality, the higher the leverage, the higher the financial leverage, or the operating leverage and the financial leverage, the more risky the firm is. That's why they've got to return so much, because they're so risky. Questions? Okay, we know we're going to have to do this as an equation, so here we go. Basically, you can find the beta of the underlying asset, this thing right here, as the weighted average of the beta of the equity and the beta of the debt. And you guys already know about beta of the equity, but did you know that there is such a thing as beta of the debt? And so you can look at how the price of that bond moves with the overall market, with the S&P 500, and that would give you the beta of the debt. And E stands for the market value of the equity at the firm, so that would just be the number of shares times the number of shares outstanding. By the way, always use market values when you're doing these weighted averages. Always use market values when you're doing these weighted averages. And so that E is the market value of the equity in the capital structure. D is the market value of the debt in the capital structure. How do I get the market value of the debt? I take the debt price, or the bond price, multiplied by the number of bonds, and that gives me the market value of that debt. Okay, should this formula be on your note sheet? Absolutely. And if I give you betas of debt, you definitely need to be using this formula. But we can make a common assumption, unless I tell you otherwise, that beta of debt is 0. And here's why we can do that. Let's think about this. If times are, they're just okay. the company's going to make their coupon payment. Now, times are a little better. What does the company do? They make their coupon payment. Times are a little sketchy. The company's got the money though, what do? They make the coupon payment. Times are really great. What does the company do? They make the coupon payment. Do you see that the cash flows here are not really moving that much with the market? And so beta of debt is pretty low, and unless I tell you otherwise, you can make the assumption that beta of debt is 0. Now the cool part is, what that means is one of these terms just totally goes away. Unless you're told otherwise, you can assume beta of debt is 0, and one of those terms totally goes away. And we can rearrange then to get the beta of the equity. And the beta of the equity is just the basically total assets divided by the value of equity, the total market value of the assets divided by the total value of equity, multiplied by that beta of the assets. Well, what we're really saying there, if you recognize it, that 1 plus DE that we just found is the same thing as this right here. The beta of the equity is equal to the beta of the assets times the equity multiplier. It's the same thing. And so it's going to impact return on equity and beta of equity in the same way, this capital structure. And that makes sense because shouldn't return be related to beta? Yeah. Does that make sense? Okay, so beta of equity is equal to beta of the assets times the equity multiplier. Should this formula also be on your note sheet? Yes, but you should write on there, do not use if given beta of debt. Do not use if given beta of debt. If you get the beta of debt, you need to use the other one. Questions? Now keep in mind here, as debt goes up, the equity multiplier goes up, the beta of the equity climbs away from the beta of the assets. So you could have two firms that were identically cyclical and had the same operating leverage, were doing the same business in the same way, and they could have different betas simply if one of them was using debt and the other one wasn't. Does that make sense? Okay. So that's the end of our discussion about the security market line and how we're going to use it. Let's talk about the dividend discount model. You guys just got through with that in chapter 6. It's D1 over P0 plus G. In other words, the dividend yield plus the capital gains yield. And remember, in chapter 6, we talked about estimating G using either ROE times B. By the way, what's B? Retention ratio. What's another name for the retention ratio? Yeah, the plowback ratio. And then ROE is return on equity. Or we could use the historical growth rate. So those are the two ways that we're going to estimate that. Now, here's the downside. That doesn't work for firms that aren't paying dividends or who are not paying dividends at a constant rate. In those cases, you're going to have to use the security market line. In those cases, you have to use security market line. In other words, security market line should work theoretically for any company. But the dividend discount model only works for companies who are paying dividends and those dividends are growing at a constant rate. Questions? Okay, when we start next time, we will be talking about the cost of debt. But spoiler alert, it's just the yield to maturity on the outstanding bonds. Are there any questions? Okay, if you want to see your exam, you need to send me an email, let me know so I can get it prepped for you to look at during my office hours. Have a good day. I'll see you next time. Okay, last time, where we left off, we were getting ready to talk about the cost of debt, and I gave you a spoiler alert that it's just the yield to maturity on the firm's publicly traded bonds. So how do I find that sort of thing out? Just the same way you find out a stock price, we can go out and you remember our bond quotes, they have that asked yield on them. You can use that. Now, the bonds may have different yield to maturity depending on the different things that are in the covenants or the different things about the bonds, whether they're secured or unsecured. And so what you actually want to look here at is the weighted average of the bond's yield to maturity. So let's talk about how we would come up with the weights. So let's talk about, this is three different bond issues. A, B, and C. And we're going to have price for each of these. And so it would be 990, 1010, 1000. And then we would have the number of bonds. And so I'm just going to make it some really easy numbers here. What about 10, 100, and 20? And so then we can figure out the value of each of those bond issues. And all we have to do is take this number times this number to figure out, and by the way, these are market values. That's why we're using price instead of face value, because if we use face value, that is not the market value of the bond unless it just happens to be a par bond. Okay, so 990 times 10 would be 9,900. 1010 times 100 would be 101,000. And then this last one would be 20,000. What I'm going to do is I'm going to add all those market values up. So we've got 121,000, 130,000, 130,900. Feel free to check my math if you'd like to there. But then I'm going to figure out a weight for each of these. And so what I could do is just take this 9,900, divide by 130,900. I'm going to take this 101,000, divide by 130,900. And I'll take that last one, 20,000, divide by 130,900. And all of these weights, by the way, what should all the weights add up to? Yeah, they got to add up to 1, right? If they don't, you've done something wrong. So what would we do from there? Well, the yield to maturity overall is going to be x of A times the yield to maturity on A plus x of B times the yield to maturity on B plus x of C times the yield to maturity on C. And of course, we would know all those yield to maturities if we were truly working this out. It's just a weighted average, right? Although my colleagues say that you could flunk an entire class just by asking students to figure a weighted average. It's actually pretty easy, isn't it? Any questions? Okay, now it's been done this way a long time before I came around, but I think it's actually being done wrong because yield to maturity, if you remember, is an APR. And so if you've got any more than one coupon per year, then these yield to maturities do not represent an effective annual rate, which is what we should actually be looking at. But hey, nobody listens to me on this, so you guys do it the way that we've all been taught, and that is use yield to maturity. You don't have to figure that effective annual rate. Okay, any questions so far? Okay, now we mentioned something weird about debt versus equity. We said that debt, the interest, is tax deductible. Are the dividends for equity tax deductible? No, not at all. And so we're going to see that there's a difference also in how we handle this when we're trying to figure out the firm's overall cost of capital. And that is what the next slide is all about. The weighted average cost of capital, or WACC. So what we're going to do is we're going to take a weighted average cost of the equity plus we're going to take the proportion of equity in the capital structure times the required return on equity. And we're going to add the proportion of the capital structure that is debt times the after-tax return on debt. Now, the after-tax return, or the after-tax cost of debt, would just be the nominal amount, the yield to maturity that we come up with, multiplied by 1 minus t. And the reason we do that is because we can deduct that from our taxes. So it saves us on our taxes. We should definitely take credit for that. Now you look at this and you say, well, wait a minute. Why wouldn't we just use as much debt as we possibly can? Because number one, it's a lower required return to begin with. And number two, you get this neat tax break. And so by those two thoughts, you'd end up thinking, well, hey, we should have 99.9999% of debt in our capital structure. Do you see companies doing that? Absolutely not. If they did, they'd be a lot like one of my neighbors. He's a spine surgeon. I won't tell you which hospital. You might be able to narrow it down. But the man, he's got probably $250,000 in student debt. He's got a brand new BMW M5, and his wife drives something really fancy, and they're always going on these fancy vacations and whatnot. The man is up to his eyeballs in debt. If he gets 1 or 2 fewer spines a month than he was planning, he's in a world of hurt. And so he might easily go bankrupt. The trick is, the more debt you have, the easier it is for you to go bankrupt. And so what we look at here is that there's a certain point where you're balancing these things off. You're just balancing off that cost savings versus the expected cost of going broke. So the expected cost of going broke is the profitability, or the probability of going broke, multiplied times what we think would cost us to go through bankruptcy. Well, the more debt you've got in the capital structure, the higher that probability of going bust is. I'll give you an example. My parents have no debt whatsoever. What's the probability of them going bankrupt? 0. Does that make sense? Okay. So let's take a look down here. How do we come up with these weights? Well, E is the market value of the equity. What is the market value of the equity? It's the number of shares outstanding times the price per share. So E is the number of shares outstanding times the price per share. And we've already talked about D here. In this case, the market value of the debt would be $130,900. And so it's the price per bond times the number of bonds, and then we have to add all the different issues together. By the way, should you expect to see something like this in an exam? That'd probably be a low probability outcome, but I want you to know how to do it. Now, I'm not saying it's a 0 probability outcome, but it's low probability. Okay, and then if we add the debt and equity together, that gives us the market value of the assets. Because after all, total assets equals total debt plus total equity. And so you can think of this, E over D plus E is what portion of the assets are financed with equity, and you can think of D over D plus E as what portion of the assets are financed with debt. And we're going to multiply each of those times the after-tax cost. Well, the after-tax cost of equity is exactly the same as the before-tax cost of equity, because the cost of equity is not tax deductible. Remember, you can't write off your dividends from your taxes. But the after-tax cost of debt is R sub debt, which is the yield to maturity that we are going to figure out up here, times 1 minus the corporate tax rate. 1 minus the corporate tax rate. Now you got to be careful when you read these problems, because sometimes they will give you the before tax cost of debt, the yield to maturity, but sometimes they'll be sneaky and they will give you the after tax cost of debt. If they give you the after tax cost of debt, should you multiply times 1 minus t? No. I'm sorry. She swung and she missed. Yeah, she had a 50-50 chance there. Okay, so basically what we're saying here is if they give you the after-tax cost of debt, that is equal to R sub det times 1 minus t. R sub det times 1 minus t is the after-tax cost of debt. R sub det by itself, or yield to maturity, is the before-tax cost of debt. So, as with every other finance problem, you got to do reading before you ever get into the math. Read and see what they've given you. Questions? Okay. So here is our WACC example. Our firm is financed with 2/3 debt and 1/3 equity. So you can think of D being 2, E being 1, 2 plus 1 is 3. By the way, what do the weights in this equation have to add up to be? Yeah, they've always got to add up to 1. And so our required return on equity is 15%. Our required return on debt is 12%. I also could have told you that was the yield and maturity. And our corporate tax rate is 25%. And so basically we're looking at 1/3 times the required return on equity, which is 15%. And if we do that math, that's 5%. And then 2/3 of 12% times 0.75. What is 2/3 of 12? 8. Very good, 8. Okay, so 8 times 0.75 would be 6. And so now we've got 5% plus 6%. I think you just skipped ahead to the final answer. She's always working ahead. Okay, so 5% plus 6% tells us that the required rate of return on the whole firm's capital structure is 11%. Now, this is some pretty easy math, but how do people screw it up? People screw it up usually through one of two things. Either they treat the after-tax cost of debt as the before-tax cost of debt, or the other thing is they screw up the order of operations. Do you guys remember the order of operations from algebra? Please excuse my dear Aunt Sally. P is parentheses, excuse is what, exponents, M is multiplication, D is division, addition, and subtraction. So, what's the first thing you should do up here? Yeah, the parentheses. So that's the first thing I'm going to do. And then I'm actually going to do that second term, and I'm going to do store 2. I'm going to do the first term, I'm going to do store 1, and then I'm going to say recall 1 plus recall 2. And that will help get rid of the great majority of the kind of math problems that you would typically see that students make on these kinds of questions. Questions? Yes?
Okay, sorry, I just want to clarify the before versus after tax.
Okay.
So, the before is when they give it to you, but after is like they have to tell you that it's after.
Okay, so if they tell you the required return on debt and they don't say anything else, you assume that is before taxes. If they tell you yield and maturity, you know it's before taxes. But if they say the after-tax cost of debt is, then we don't multiply by 1 minus t, because after all, they've already considered the taxes. It's after tax. In other words, just don't consider the taxes twice. Does that make sense? Good question. Other questions? So let's talk about the risk of the project and whether we should use WACC. If the project is just as risky as the rest of the firm, then our WACC is the appropriate discount rate. So I'm going to give you an example here. There's a car company called Nissan. Are you familiar with Nissan? Yeah. And they make a car called the Altima. Are you familiar with the Nissan Altima? I used to own one. This has got to be about the most boring car possible, and I don't mean stylistically. I mean, it's got an internal combustion engine, it's got proven technology, it's in a market segment that we have a lot of information about, it's got a good solid demand from the rental fleets of the world. I mean, there's all sorts of boring things about the Nissan Altima. So if I were Nissan and I were talking about expanding the Nissan Altima production line in Mississippi, I would use the firm's overall weighted average cost of capital for that project. Now let's talk about another potential project. Have you guys heard of the Nissan Ariya? The Nissan Ariya is an electric SUV that's supposed to come out and compete with the Tesla Model Y, I think. Okay, now let's talk about why that might be a riskier project. First of all, do we truly know the demand for electric vehicles yet? No. For one thing, the picture is clouded by government subsidies. And we know from China, when the government steps back from providing these subsidies, what do you think happened to the sale of electric vehicles? Yeah, they went down. In fact, they like crashed. And so the government's like, whoa, and they put that back, right? So we truly don't have an idea about the market. Number two, the technology is getting a little bit mature, but it's new technology. Let's talk about the risks that go along with electric cars. What kind of batteries do they use to store the electricity in electric cars? Were they alkaline batteries like you put in your, no. What are they? Yeah, lithium ion batteries. Now, if you had a Note 7 or certain Dell laptops, you might have had the unfortunate incident of having your phone or laptop catch fire. Just spontaneously catch fire, which was really bad if you had your Note 7 in your pocket, right? Okay, now let's think about where they put the batteries in these cars. As a former engineer, I can tell you that if you want a car to handle better, you want its center of gravity. That's the imaginary point about which all the mass is concentrated. You want that to be as low as possible in the car. And batteries are great for that because they are so heavy, right? And so we're going to put the batteries on the bottom of the car, and that makes it handle really great. There's only one problem. Who's sitting on top of the battery? Yeah, the driver. So let's follow the bouncing ball here. You're sitting on the battery catches fire. Talk about your chestnuts roasting on an open fire, right? This is a recipe for disaster. And so we see many reasons why this Nissan Ariya might be a riskier project than the Nissan Altima. And so as a result, we would need to use a required rate of return that was higher than the weighted average cost of capital for Nissan overall. How would we figure out what that should be? Well, we should try to find a pure play electric car firm, meaning that is all they do. They only make electric cars. And we could use their weighted average cost of capital as our required return for this project. Well, let's walk through some of the possibilities here. What's the biggest electric car maker that we know about? Tesla. Is Tesla a pure play electric car company? No, what do they do?
They got a lot of space stuff.
Okay, so that's actually SpaceX, it's a different company. You're thinking about Elon Musk. But Tesla itself, is it a pure electric car company? No, what else do they do? Tequila. Okay, so let's get all the fun ones out of the way. Tequila, flamethrowers, right? More important, and do you think that's a big portion of their business? No. What is a big portion of their business, though? Solar. So a while back, by the way, Solar City was ran by, and the idea was Elon's, but he gave the idea to his cousin, who started Solar City. And then Elon used his power at Tesla to get Tesla to buy out Solar City. Does that sound a little shady? Yeah. Okay, so back to the story. What does this bring us up to today, though? Tesla is not only in electric cars, they're in solar power. So I can't look at their weighted average cost of capital and use that as the appropriate rate for an electric car project. And so then we have some other ones now. We've got Lucid. I'm not even sure if they're publicly traded. But you can, and then there's, who's Rivian, right? So there are these other electric car companies we could look at if they're publicly traded and figure out their weighted average cost of capital. And then what I would do is basically take the average of those and use that as my required return for this Nissan Ariya electric car project. Does that make sense? That's the ideal way to do it. But oftentimes, especially if you're doing something brand new that nobody else has done before, for instance, Elon Musk is now trying to hook human brains to computers. If you were to go out and try to find weighted average capital costs for pure play firms in hooking human brains to computers, how many companies would you find?
None.
Yeah, exactly, 0. And so what do you do in that situation? Well, a lot of companies have what's called a bump up or a bump down for these projects. You bump up for the riskier projects and you bump down for the safer projects. So let's say the weighted average cost of capital for the firm is 9%. Maybe they say, well, we add 3% for riskier projects and we subtract 3% for safer projects. Well, there's a problem with that. Number one, you only have 3 points. We'll show you here in a minute why this is a problem. But the thing it leads to from a human perspective is what we in industry would refer to as a pissing contest. Now, I'm using crass industrial terms here, but you guys are going to run into them anyway, so we might as well. Okay, so what do we mean about this contest? You get into the conference room, and then everyone starts to argue that their project is safer than the other person's. Why do they want to argue that their project is safer? Any ideas? Say again? Yeah. So let's follow this through. If it's safer, then we use a lower discount rate. Therefore, the NPV is higher, and it's a greater likelihood that that project will get picked. And I'd walk into these meetings and I would be truthful about my projects, and I would just get my hat handed to me and told to leave because the room was full of liars. By the way, did you know that people are scumbags? Yeah, so I'm going to throw just a first name out here, Jason. Jason would always come in and he's talking about how safe his projects are and throwing out all these, and it was total crap. My projects were all based on technology that was 100 years old, springs and metal tubes and basically rubber bands, O-rings. His stuff was like cutting edge stuff and the market was unproven. And so definitely my stuff was safer than his, but he was a better liar than me. So who do you think got their projects approved? He did, not me, right? Does that make sense? Okay, any questions before we move on? So, here's what happens if we only use the weighted average cost of capital and we don't adjust for the risk of the individual projects. What we have here is on the horizontal axis, we have the beta of the project, and on the vertical axis, we have the discount rate for the project. Now, in theory, we should be working along this security market line. And any project above the security market line should be accepted because it is returning more than is required for that level of risk. And anything below the security market line should be rejected because it is not providing enough return to compensate us for the risk that we're taking. So what happens though if we just use the firm's overall cost of capital here? Well, we end up with a situation where we are rejecting safe, profitable, positive NPV projects and accepting risky, negative NPV projects. So take a look over here in this little triangle on the left. It says reject profitable, low risk project. Notice that that's above the security market line, but it's below the weighted average cost of capital. If we're just using that one rate, we'll reject that. On the other hand, we're going to be accepting these projects that are above the weighted average cost of capital, but below the security market line on the risky side of things. So what's that going to do to our assets over time? Well, our assets are going to become more and more risky because we are rejecting safer projects at a rate higher than we should, and we are accepting risky projects at a rate higher than what we should. And so as a result, the risk of our assets overall goes up over time. Now, I don't mind the risk of the assets going up as long as the return follows with it. But are we getting that return here? No. We're actually getting lower returns because we are doing negative NPV projects we shouldn't be doing, and we're rejecting positive NPV projects we should be doing. And so as a result, the risk is up, the reward is down. That's what's so dangerous about this. Now, you remember earlier I told you that if we did the bump up, up, down, now, so here, there's only one place where this is correct, and that is where those two, there we go. That's where those two lines cross, right? There's only one place here, and that is for the Nissan Altima type project. There's only one way, one place that this works out. If you do the bump up, bump down, then you've got 3 horizontal lines, and you'll have precisely 3 places where this is correct. So I suppose you could say the bump up, bump down might be 3 times as good as this one, but it's still pathetically, underwhelmingly bad, right? Okay. Let's see. Looking at this now, you say, well, certainly no one would be dumb enough to use just one rate for the overall firm. The year's 1994. I go to work for a Fortune 500 oil field services company, and I'm doing this kind of stuff. By the way, 95% of my calculations as an engineer were net present value, which is weird, right? You'd think it would be stress calcs and things like that. But back to the story, I said, okay, what's the required rate of return? And they say 11.9%. And I said, well, does it matter the riskiness of the project? They're like, no, they're all the same. 11.9% regardless. Now you might think that, you know, the oil field, it's full of some unrefined people. Maybe they're just not that smart. Moving forward, the nation's largest private employer, a retail chain that's based just south of here, I was talking to their VP customer experience, and he's one of our alums, so I met him in the dean's office, and we're talking, and I said, he told me what he did, and I said, oh, you know, I wouldn't know much about that. I'm a finance guy. He says, oh, on the contrary, every new project we come up with, we have to send it to finance, and they have to make sure that it clears the hurdle rate. I said, the hurdle rate? Do you mean there's just one rate for everything at the company? And he said, yes. Now, this is an organization that hires Harvard MBAs in their finance department. So what this tells me is right now, your education here at our school is better than that at Harvard, because at least you guys know not to do this crap, right? Let me see if you were listening. What's going to happen to our assets over time if we do this? Yeah, they're going to get riskier. Are we going to be rewarded with additional return? No, in fact, it's going to go the other way. Questions? Okay. So now we're on to something called flotation costs. If you think back to bonds, we had that sinking fund, and we said the reason it's called a sinking fund is because the opposite of sinking is floating, and when you float a bond issue, it's you're borrowing more money. And so you can float stock issues, you can float bond issues, but anytime you do that, you're going to have to work with someone called an investment banker. If I say investment banker and you picture in your head what kind of car they drive, what are you picturing? Yeah. A what?
A really nice one.
A nice car, okay.
Mercedes.
Mercedes, maybe an unsuccessful one. These people on Wall Street bonus day is the day when most Ferraris get sold. I am not kidding. These people's bonuses are enough to go out and buy a Ferrari, and good for them. But where does the money come from? The money comes from flotation costs. Anytime a company wants to issue new stocks, new bonds, they have to work with these investment bankers, and the investment bankers take a cut. And that cut represents the flotation costs, the costs that the investment banker requires in order to help them take their stuff to market. Now let's talk about flotation cost for debt versus equity. Which is safer, debt or equity? Oh my goodness, I have failed so miserably here. Okay, let's think back to the line of people getting money at the firm. Who gets paid first, debt or equity? Debt. Who gets a fixed set of payments? Debt. And so we're basically looking at a much safer claim on debt. And so what happens, the way this works, is the investment bank actually buys the securities from the issuing firm and then swings around and sells them out to pension funds, mutual funds, really wealthy individuals and things like that. But during the time that they're holding on to this, the investment bank faces something called inventory risk. So for instance, if you're holding on to the bonds, and during the time you're holding on to the bonds before you can sell them on, the interest rate shoots up. What happens to the value of those bonds? They go down, right? And so that's the risk of holding this inventory. But that risk isn't nearly as much as the risk with equity, especially if we're talking about an IPO, which is an initial public offering. Do we know how much the equity is truly worth at that point? No. And so you end up with a hugely, so it's like little s, big W-A, little g. It's a scientific wild ass guess, right? And so people are using all sorts of models to come up with what they think the market will bear. But the problem is this: when they actually get around, by the time they get around to selling the shares, people may not be interested in paying what they thought it was worth. So example, a firm called Vonage. Vonage does internet telephony. Anybody with an internet connection and enough money to buy the hardware can do this. And the first time I saw it, I told my wife, I said, that business has no competitive advantage. In other words, anyone can get in there. There aren't really big barriers to entry. And it wasn't much longer after that they announced they're going to have their IPO. Why do you think they're going to have their IPO then? Before the rest of the world figures out that they really don't have an advantage here, right? So they're going to take the money and run, which, you know, from the goal of financial management, maximize shareholder wealth, they're doing the right thing. And the current shareholders at that point are the founders. Does that make sense? And so what do? They get, and I'm making up the numbers here, but the idea is similar. They get an investment bank to buy these shares for $22 a share, thinking that they're going to turn around and sell them for $25. But when the investment bank turns around to sell them, they end up having to sell them for $17. And so the investment bank actually lost a boatload of money on that. Now, is it common for this to happen? Absolutely not. Is it disastrous when it does? Absolutely. And so that's why they're requiring these higher flotation costs for equity. It's an insurance policy against something like that happening. Does that make sense so far? Okay, now we're going to end up with people who say, well, wait a minute, since flotation costs for debt are lower, then we'll just finance all of our future projects with debt. What's the problem with that? What did we say earlier happens as the level of debt at your company rises? Say again? Yeah, you raise your probability of bankruptcy, and we don't want that. In fact, we think, theoretically, that most firms should have a target debt-to-equity ratio. There we go. Most firms should have a target debt-to-equity ratio. So for different businesses, it's different. For banks, the total debt ratio would be around 90%. For electric utilities, it would be around 50%. For biotech companies, it would be around 0%. But if we issue debt for every single project, it's going to start pulling us away from our target ratio. And so we don't want to do that. So what we're going to assume is that every single time we fund a project, that we are going to fund it with a mix of debt and equity that matches our current capital structure, even if in the end that is not how we end up financing the project, because otherwise we could be disadvantaging some projects and over-advantaging others. Do you remember my colleague Jason, who had always argued that his projects were safer? That's the kind of person that would argue, well, hey, this next go around we're going to be issuing debt, so you should look at my project with debt. Well, then my project comes after his. He's like, oh, well, it's obviously time to issue equity, so Haggard's project needs to be looked at using the flotation cost of equity, which is higher. It would disadvantage my project and advantage his. Okay, now one other thing you need to know about flotation costs before we move on is that they do not impact the weighted average cost of capital. And in fact, you will see some finance textbooks that actually say, oh, we should add these together. Those people are on crack. It is not right. And the reason it's not right is because flotation costs are basically a cash flow at time zero. It doesn't affect the remaining periods. It doesn't have anything to do with the cost of capital beyond that time zero. And so the way we are going to account for flotation costs is at time zero in dollars. At time zero in dollars. And so if I go out and issue $100 million worth of securities, and then I end up having to pay 10% flotation costs, that 10% of, how much did I say? I forgot what number I threw out there. Let's say it was $1 million. 10% of $1 million is $100,000. We're going to have $100,000 of flotation cost at time zero. And by the way, that leaves us only with $900,000 to spend on our project. And we've already talked about this, so we'll just skip straight by it. So what is our weighted average flotation cost? By the way, this part, we are looking at percentages. We will get to the dollars that we include in our project, but this is talking about percentages. In the real world, the flotation cost of equity is around 7.5%. It's around 7.5%. But you don't need to know that. I will always give you the flotation cost for equity and the flotation cost for debt. And then we're going to figure a weighted average. Do you recognize the weights? Yeah, they're exactly the same ones that we were using earlier today. And the only thing that I want to point out that's different between this and, let's see, yeah, there we go. This and the weighted average cost of capital is there's no 1 minus t here. And that is, for tax purposes, flotation costs of debt and flotation costs of equity are identical. One of them does not have a tax advantage over the other. And so we treat them identically the same when we're looking at flotation costs. So F sub 0 is the weighted average flotation cost. F sub S is the flotation cost of stock or equity. F sub B is the flotation cost of bonds or debt. And we've already talked about that tax issue. One final note here. What if you're using internal equity? Remember that we can, when we have net income, there are two places it can go. If we don't pay it out as a dividend, where does it go? Addition to retained earnings, which flows off of the income statement onto the balance sheet and lands in, oh, come on, Ms. Hip, where do you think it lands? Oh, I was hoping she was going to get both free throws there, but it's yeah, I'm sorry, that was corny. Ms. Hip's a basketball player, in case you didn't know. Back to the story. It's the accumulated retained earnings. Accumulated retained earnings is where this shows up on the balance sheet. And that shows up under equity. You know, we've got assets on this side and liabilities plus owner's equity over here. It shows up under equity. And so we call any money that we've earned but haven't paid out as dividends, we call that internal equity. Does it cost us any money to go out and raise that money? No, it's already sitting there. And so we don't have to have a flotation cost for it. In fact, the flotation cost for that is 0. And so that gives a little bit of an advantage to equity here if we have internal equity. But if we have to go out and raise it by issuing additional stock, then we have to consider that flotation cost of equity. Does that make sense? Okay. So here is our weighted average flotation cost example. Our company is financed with half debt and half equity. So you can think of D being 1, E being 1, and D plus E would be 2. And the debt has a flotation cost of 5%, and the equity has a flotation cost of 15%. So what is our weighted average flotation cost? Well, we just take 1/2 times 15% plus 1/2 times 5%, and that gives us 10%. What does that mean? If I go out and raise $100, they're only going to hand me 90. So I'm going to sell $100 worth of stock. They're only going to give me 90 in cash. That other 10 goes to the investment bank to help buy Ferraris, Lamborghinis, those sorts of things. Now in this case, we need 100 million. We're looking at a factory. We're going to build a factory. We need to put the machines in it. We need to buy the land, all that kind of stuff. We need $100 million. If I just go out and issue 100 million of new securities, it's going to actually net 90 million. Would I have enough to do the project at that point? No. And so what this means is I've got to go out there and not only raise enough money for my project, I've got to raise enough additionally to cover the flotation costs. I've got to raise enough additionally to cover the flotation costs. And so we could say, well, the amount that we need has to be equal to the amount that we're going to go out and raise times 1 minus those flotation costs. So in this case, 1 minus the flotation costs is 0.9. And we need to multiply the amount that we're going to raise by that in order to get our 100 million, the amount that we need. Well, we need to rearrange that to figure out how much we need to go out and raise. And I do that simply by dividing both sides by 1 minus f sub 0. And so now we know we've got to go out there and raise 100 million divide by 1 minus 0.10. We have to raise $111.11111 million in order to be able to have 100 million when this is all said and done. And so what does that mean for our analysis that we're going to do, our NPV analysis? It means our time zero cash flow is going to be minus 111.11111 instead of minus 100, because we're going to include that flotation cost. In fact, if I ask you the question, how much are the flotation costs in this example, what would you tell me, Mr. Zach? How much are the flotation costs in this example in dollars, please? Say how much? Oh, well, you're getting close. Yeah, 11.11111 million, right? Yeah. Okay. Now, let's ask this. You say, well, wait a minute. It's really not that big of a deal. Let's ask this. If I had a project that was positive NPV $5 million before we looked at flotation costs, under the rules of NPV, we would accept that project. However, if I now include this 11.11111 million in flotation costs, now the NPV is negative $6.11111 million. Do I accept or reject? It's a negative. Yeah, you got to reject it, right? And so it can change your decision on a project. So we have to include it. It's a real cost.